On May 6, 2010, the U.S. stock market experienced a bizarre and sudden phenomenon known as the flash crash. In a matter of minutes, the Dow Jones Industrial Average plummeted nearly 1,000 points, evaporating roughly $1 trillion in value. Was it a rogue trader? A glitch in the system? Or something more sinister? Theories abounded as people attempted to explain this unprecedented event. How did a nondescript man from London orchestrate such a massive crash in the U.S.? Stock market? His family had roots in the Punjab region of India, and he grew up practicing the Sikh religion. However, as he grew older, it became clear that Navin wasn't like most kids. His job was basic: buy and sell contracts based on the movements of various financial instruments. He developed his own software programs, creating complex algorithms that could analyze vast quantities of market data, predict price movements, and automatically execute trades. This innovation laid the groundwork for the sophisticated strategies that would later bring both fortune and infamy to the Hound of Hounslow. But what set Navin apart was his ability to absorb vast amounts of data, spot patterns, and make quick, accurate predictions. He was playing the market purely on probabilities, on his ability to forecast price movements. It also gave him an advantage over traditional brokers because it meant that he didn't have to worry about things like settlement cycles or clearing and settling trades. His rise was meteoric. Within 3 years, he was grossing $1 million a month, and by 2010, he was pulling in a staggering $2 million per month. In February 2010, the Commodity Futures Trading Commission, or CFTC, issued a warning about spoofing in the futures market. Spoofing, for those unfamiliar, is a manipulative trading practice where traders place fake orders to deceive other market participants. He was just a middleman who could place orders and move on to the next one. On May 6, 2010, during the lunch hour on Wall Street, a sudden and inexplicable surge in sell orders caused the stock market to plummet. Within minutes, the Dow Jones Industrial Average fell nearly 1,000 points, wiping out nearly $1 trillion in market value. These algorithms rely on making very small price movements and take profits over millions of trades. Leverage allows traders to control more money than they have available, amplifying their returns. Now, it's important to note that while Navin was identified as a major contributor to the flash crash, he wasn't solely responsible for it. He placed huge orders that triggered these algorithms, causing them to amplify the price fluctuations. In effect, he became a sort of puppet master, pulling the strings of these algorithmic systems and manipulating them to his advantage. Rather, his actions combined with other factors created a perfect storm that led to the crash. However, it also amplifies their losses, and in a volatile market, this can lead to substantial downturns. For instance, he utilized multiple accounts and trading venues, making it harder to track his activities. In essence, Navin operated in the shadows, taking advantage of blind spots in the market's monitoring systems. His actions highlighted the vulnerability of even the most sophisticated financial markets to subtle forms of manipulation. He also employed sophisticated software that allowed him to place and cancel orders extremely quickly, further complicating any attempts to monitor his trading patterns. He gained international recognition and has since enjoyed a significant amount of freedom. He was able to walk away with millions and live out the remainder of his sentence in relative comfort. He was sentenced to 4 months in prison, but due to his unique condition, he was allowed to serve his time at home. Authorities are continuously working to adapt and stay ahead of traders who seek to exploit new technologies and market structures. And the constant struggle between those seeking to manipulate markets and those trying to keep them fair. Whether you see him as a brilliant strategist or a manipulative fraudster depends on your perspective. There is no denying that he left an indelible mark on the world of finance, and his story continues to resonate in the corridors of Wall Street. It's a cat and mouse game that will continue to shape the future of trading. This creates an artificial impression of high demand or supply, attracting other traders into the market. This warning from the CFTC marked one of the first official acknowledgments of spoofing as a growing concern in the market. And ironically, It happened just 3 months before the flash crash. Why did the market fail to anticipate such a calculated move? How could a single trader shake the foundations of Wall Street? His ability to focus intently on patterns and numbers played a significant role in his success. It makes us wonder if there are more individuals like Navin out there whose unique neurological perspectives could offer an edge in the market. And what does this say about the vulnerability of our financial systems? Despite his brush with the law, he remains a prominent figure in the financial world, often giving talks and interviews about his experiences. The sheer volume of data generated makes it challenging to monitor and analyze, especially when looking for subtle signs of manipulation. Moreover, the flash crash occurred during a time when monitoring systems weren't sophisticated enough to detect spoofing activities effectively. It was almost like a David and Goliath story. Here was a lone individual going toe-to-toe with the heavyweights of Wall Street. Now, you're probably wondering, how did Navin get away with this for so long? Well, it comes down to the complexity of the market and the limitations of technology at the time. Once the unsuspecting traders enter the market, the spoofers swiftly cancel their fake orders and execute their genuine trades at favorable prices. He struggled with social interactions, had a limited range of interests, and displayed repetitive behaviors. Regulators and academics rushed to uncover the root cause of this unexpected crash. And what they discovered was a perfect storm of circumstances that culminated in the flash crash. At the age of 14, he was formally diagnosed with Asperger's syndrome, a form of autism spectrum disorder. This meant that he never physically executed the trades he made. Instead, he simply relayed buy and sell orders between the real players in the market. Although this may sound like a minor distinction, it proved crucial in the flash crash. Well, let me tell you, this is a tale of wits, of strategic brilliance. Brokers facilitate trades on behalf of investors, connecting buyers with sellers. When someone places a trade, the broker routes the order to the appropriate exchange where buyers and sellers meet. He could place multiple trades in a split second, adjusting his positions as needed, all without worrying about the logistical challenges associated with physical execution. This gave him an edge that few of his competitors could match, setting the stage for his audacious exploits. The exchange acts as an intermediary, ensuring that the terms of the trade are met and the transaction is executed. And of how one man's unique understanding of the market led him to exploit its weaknesses. Let's dive in. It was the largest one-day point drop in stock market history and left investors stunned. As panic swept through the financial world, the authorities scrambled to identify the cause of this dramatic crash. Interestingly, many investigators soon converged on a common suspect, a quiet young man named Navinder Sarao who lived in a modest home in the suburbs of London. Yes, that's right, London. And it turns out that the man responsible for shaking the very foundations of American finance was none other than the so-called Hound of Hounslow. But hold on. You might be thinking, who is this guy? Navinder Sarao was born on December 7, 1982, in Hounslow, West London. Despite these challenges, Navin was exceptionally bright and his mind was particularly drawn to numbers and patterns. After graduating from school, instead of pursuing a conventional career path, Navin decided to educate himself about the stock market. He wanted to try his hand at day trading, which in retrospect is somewhat ironic given the havoc he would later bring upon the market. Navin began small, working as a simple market maker for a spread betting firm called Cantor Index. In the early 2000s, Navin began exploring the world of online trading. One of the notable advantages that Navin enjoyed was his status as a non-executing broker. You see, the stock market works through a network of brokers and exchanges. Being a non-executing broker gave Navin a significant edge. He could place orders without actually having to hold the underlying assets. In essence, Navin leveraged his status as a non-executing broker to operate with incredible speed and flexibility. In 2007, at the age of 24, Navin founded his own brokerage firm, Navinder Sarao Limited. But while Navin was raking in the cash, dark clouds were forming on the horizon. Essentially, spoofers make their presence felt by placing large buy or sell orders when in reality they intend to cancel them. This practice is illegal and unethical, but until recently, it existed in a legal gray area, making it hard to detect and prosecute. So, what was the flash crash and how did Navin find himself at the center of it? It was the biggest one-day point drop in stock market history and left investors reeling. One of the key factors was an increase in the use of high-frequency trading, or HFT, which involves using advanced computer algorithms to execute a large number of trades in a very short period. Another factor was the proliferation of leverage, which magnifies both the potential profits and losses of a trader by borrowing money to invest. Now, here's where Navin enters the picture. His actions played a significant role in exacerbating the situation. According to the CFTC, Navin capitalized on the chaos created by HFT algorithms and leverage. What makes this story particularly fascinating is that Navin operated from his home in Hounslow, London, and was able to impact the American market so profoundly. And as investigations deepened, it became clear that Navin had pulled off one of the most audacious financial stunts in recent history. The stock market is a highly complex system involving numerous participants and market infrastructures. Navin exploited this gap by using techniques that were difficult to detect. It wasn't until after the crash that regulators and market operators began to develop more sophisticated surveillance systems that could detect these manipulative tactics. Following his arrest in 2015, Navin eventually pleaded guilty to spoofing and agreed to pay back $12.8 million. Today, Navin lives a relatively low-key life in London. In hindsight, the flash crash turned out to be a blessing in disguise for Navin. Looking back at the story of the Hound of Hounslow, several questions rise. Moreover, Navin's unique situation as an autistic trader raises interesting questions about the role of neurodiversity in the financial world. Furthermore, the story highlights the evolving nature of financial regulation. In conclusion, Navinder's story is a testament to the power of human ingenuity, the complexities of the financial world,